Hello everyone, welcome back to Upside Down Data. Today I want to talk about rethinking Bitcoin fair value beyond what we generally see with these kind of time-based log regression models. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So I want to talk about a bit of a different topic today than things that we usually cover on the channel. And I want to talk a little bit about this idea or this concept of fair value for Bitcoin. You've probably heard that term before, and a lot of people, when they talk about fair value for Bitcoin, the way they go about assessing it is using these kind of logarithmic regression analyses, right? They'll use time as their primary input value, and they'll plot the best fitting curve, the best fitting logarithmic curve over the Bitcoin logarithmic price here. And then the idea being that this red line that I'm showing you here would be considered that kind of fair value, kind of that midline, that trend line that Bitcoin has historically generally followed. And so being above that line might suggest you're kind of in a bubble, you're overvalued. Below that might mean that you're undervalued from a historical perspective. So I think there's certainly some strengths to conceptualizing fair value this way, but I also want to take things a step further to talk about a different way we might be able to think about this, or a different way that we could apply logarithmic regression to get a slightly different picture of what we're looking at. So certainly one of the advantages of using this type of analysis to approximate fair value, quote unquote, is that it's a lot more robust to the issue of overfitting than some more complicated models, right? So with this line I'm showing you here, this is fit to just all of the data that Bitcoin's price history, just all of it I'm fitting this curve to. You could fit it instead only up to data, for example, to the beginning of 2018, so right here. And what you'll notice is that the line is very similar if you do that to what it was, what I was just showing you, right? So the main thing you'll notice is that the curve is just a little bit shallower down here than it is up here. But overall, if you would fit this line, you'd fit this model to just up to this point, you know, you'd be pretty reasonably happy with the results that it's been producing, right? You know, slight deviation, but it's not too bad. And what that might suggest is that this model has some predictive ability into the future, right? It's still able to give a reasonable guide of Bitcoin's kind of fair value or median average, however you want to consider it, price. That's not too dissimilar from if you just fit to all the data that's here. And so that's one of the advantages of this type of approach. But there's other ways that we can think about this. There's other ways that we can try to assess what Bitcoin's fair value is right now, and particularly if we don't care so much about being able to project, you know, years into the future, some of these other approaches might be a little bit more, give some other information that is helpful, that's useful beyond what we just see with this singular curve here. So what I want to talk about is just different ways that we can conceptualize this model that we're applying to kind of determine fair value, as it were. So the typical kind of equation that people use to create these kinds of logarithmic slopes, logarithmic graphs, is basically this one here, where you have your output, which in this case is the log of Bitcoin's price, so a log transform price. And then what you'll do is you'll have some constant. I'm calling that B0 here. This is just notation oftentimes used in regressions. A B0, this is called the intercept or the constant. If you're familiar, you know, with y equals mx plus b, it's the same idea. So this would be that constant in the equation of the line. And then it's plus some regression coefficient, B1, which is fit using the regression, you know, algorithm. And then you'd have log of whatever your predictor variable is here. In this case, it is time. Now, the log that's used here, some people use different ones. It actually ultimately doesn't matter all that much as long as you are consistent in some of the different things you're doing. A lot of people will use the natural log here. You know, you can use log base 10. You know, there's flexibility in what particular base of the logarithm you use, but you'll use some logarithm of your predictor variable. And often, and with these kind of lines, what people are using to predict is just time. They're just saying that over time, Bitcoin is growing by some rate, and we just want to quantify, you know, what that rate of growth is on a logarithmic curve. And what I think is important to note about this type of analysis then is that it's kind of embracing our ignorance to some degree of exactly what drives Bitcoin's price, right? You know, time in and of itself time is not what's causing Bitcoin to increase in price, right? The actual reasons Bitcoin is increasing its price is not merely just because time is passing. That's not what's doing it. It's probably a myriad of other factors that feed into it, right? It's adoption, it's network effects, it's macro conditions that lead people to want to put more money into assets, risk assets. It might even be ideological factors that drive people to Bitcoin, etc. There's a huge slew of things that are driving this increased growth over time. And really with this time variable, what we're saying is, we're not going to try to model all of those other factors that could influence Bitcoin's price. We're just going to say, I don't know exactly what's causing it, so I'm not even going to bother trying. I'm just going to use time as this kind of catch-all variable and just say with time can act as a proxy for all these other factors that have generally been driving Bitcoin's price up at this predictable rate. That's really what this analysis is doing, is you're just saying, I'm not going to try to model those factors. I'm just going to let time be this kind of proxy factor that can just capture broadly what all those other things are doing in this one kind of overall variable. But what's important to note is that we wouldn't have to do it that way, right? That if we wanted to, we could try to get more specific. We could say, all right, there's going to be things that we're just not going to know about or maybe not be able to measure or whatever the case may be, that we could just let time be the proxy for. So that could stay in our model. But with regression, you can also run regressions that are called multiple regressions, where instead of having one predictor, you're actually predicting the outcome from a multiple different predictors. So we'll have this kind of catch-all variable time. But then we could also specify some specific variables that we think should affect Bitcoin's price to see if we can get a better fitting model, something that can explain Bitcoin's history a little bit more closely than just using this basic kind of curve like this. So that's what these would be. You could add in some other specific variable here, some other specific variable here, so on and so forth. And certainly there are other variables we could think of that are easily measurable that should have some bearing on Bitcoin's price, though maybe not causally, right? So the stock market, for example, S&P 500, we think it's reasonable to think that there should be a positive correlation between these. Now, that doesn't necessarily mean the S&P 500 is causing changes in Bitcoin's price, because it could be that there are factors that influence the stock market price that also impact Bitcoin's price without there being a causal direct relationship between the two. But again, this could act as a more specific proxy for those variables than just some general time variable. So that would be one thing that we could do. Another thing we could look at is the money supply, right? Inflation should matter for Bitcoin's price. It should actually be a negative effect, right? The more money there is in circulation, then that might actually reduce the kind of the value of Bitcoin if there's just so much kind of dollar, or potentially it could go the other way around, where if as inflation goes crazy, then maybe the dollar is debasing itself, so Bitcoin rises in price. So that would actually be an empirical question you can test: has the effect of the money supply overall been good for Bitcoin's price, or has it overall been bad for Bitcoin's price? So that's an interesting question you can actually address with this type of analysis. You can't do if you don't take into account a specific factor like M2. And then we also can think about something that's internal to Bitcoin's network, like active addresses, as being a proxy for adoption, for example. And you could speculate that the more adoption Bitcoin has, the more people are using it, the more active addresses there are on the network, the more valuable it should be. That's generally the way that networks work, is that the more usage of the network that exists, the more valuable that network is. So I'm just going to show a model where we take these factors into account. So in addition to this kind of general time variable that I'm going to let just be the kind of proxy for all the things that I'm not specifically measuring, or the proxy for things that aren't captured by these other things. So again, these different factors, there's different things that are going to be causing each of these to fluctuate. So it's not necessarily that these are causally impacting Bitcoin's price directly, but it could be that factors that are impacting these things causally are then causally impacting Bitcoin. So the issue of causality is something you always want to be really mindful of. Is that it's not to say that when we see effects or predictive ability of these factors on Bitcoin price, doesn't mean that these things are causing effect on Bitcoin's price. It could just mean that they're related to other variables that are causing those fluctuations. But they at least give us a predictive ability. In some ways, we don't really care if these are the things that are causing it or if it's something else. We just care if we can get some better prediction using these. So in some ways, the issue of causality isn't all that important, but it's just something that you should be mindful of. So this is actually what the model looks like when you do take all those other factors into account. So this is taking into account just time being that kind of catch-all variable, then also the S&P 500, M2, and active addresses on the Bitcoin network. And what we can see is it's really interesting, right? And this is quite different from what we were seeing from that purely time-based model, right? Where instead of it just being the smooth logarithmic curve going all the way up through, we're actually getting these points where it's predicting jumps up, moves up, it's predicting moves down. Now, it doesn't always bear out, right? You can see how, it actually does a reasonable job of predicting that this point back here, would be an increase going on up here. But then it's thinking that Bitcoin is quite undervalued through here, which is actually consistent with the time-based model. But then also what's kind of interesting is that actually it expects Bitcoin to get hit more heavily by the market downturn in late 2018 as well as the COVID crash than actually happened, right? You see the red line dipping way deeper in those periods than Bitcoin actually did going up. So what can this tell us that's interesting? Well, the first thing that's important to note about this is that this is a model that's fit to the entirety of Bitcoin's price history, right? So I'll talk a little bit more about overfitting in a minute. That's something that's way more of a concern with this model than with just the time-based model. So I'll get to that in a minute, but I want to talk about some other things first. What I think that this kind of model can do is give us an alternative perspective on Bitcoin's performance during some critical junctures in its lifespan. And this is kind of just retrospectively looking back, knowing now how all these other factors have historically been able to predict kind of what the overall relations are over Bitcoin's entire history. One thing I think is really interesting to note is kind of the behavior in these 2 points that I was just mentioning. Because when we kind of crypto people are more into the crypto market, think about the kind of the 2018 bear market and the COVID crash, we think of these as being kind of exceptionally painful events that are just about as bad as we can imagine, right? This is that, kind of dropping all the way down to this huge capitulation as being just awful, as being kind of the worst thing that could have happened for Bitcoin, that was super painful. But this actually provides a slightly different interpretation of those events, right? Because in fact, from this model's perspective, given its accounting for the SP 500, M2, and active addresses, that's using those as predictors, it actually thinks that Bitcoin should have been hit harder during those periods than it actually did, right? It thinks that Bitcoin should have fallen well under $1,000 during the COVID crash. That didn't happen. It thinks that Bitcoin, again, should have fallen, down closer to $1,000 in the 2018 crash. That didn't happen. Bitcoin was able to hold up at a higher level. So in some ways that suggests that Bitcoin was doing something a little bit unusual, at least if we were just predicting it purely from some of these other factors with that kind of general time factor, that it wasn't as impacted by these kind of broader factors, probably particularly in this case the S&P 500 here, than might have been expected given how the SP and 500 and Bitcoin tend to correlate to each other other times in its history. So I think that's notable, and that suggests that Bitcoin in those periods, maybe actually that was kind of a bullish aspect to it there, that it held up so well in the face of those aversive conditions. Now again, this model would not have looked the same back then as it does now, and that's of course a caveat, because the issue with this model is this issue of overfitting I was talking about. So I want to move on to that next here. So what I'm showing you here is that same model I was showing you here, but fit only up to on data until the beginning of 2018, right? So only up to this point. And what you can see is that it just doesn't fit the data all that well at all after that point, right? And the reason for that is that however the factors here are relating to Bitcoin at this point in time is not the same to how they've been relating to it when you consider the entire history, right? When you consider it up until here. And so really, from this perspective, if you just created this model up until here and let it run, then Bitcoin's been outperforming that expectation ever since, right? The model actually expects Bitcoin to be doing worse this entire time than it's ended up doing, which is notable. But again, that's the issue of overfitting, this idea that when you fit to all the data, it'll look really pretty good for that data, but then when you try to predict the future, like what we're doing here, it can start to fall off, and it kind of tends to get worse and worse over time. The further out that you get from when you fit it, oftentimes the worse it gets. Because again, there are going to be events that are going to change how these different factors relate to something like Bitcoin, right? The COVID crash is probably an extreme one, where things like M2 and the S&P 500 probably really change in the way that they're relating to Bitcoin over this time compared to how they're relating to it back here. And that's where you're getting this kind of divergence, especially showing its head. But the thing I want to ask then is, does that mean that this is a useless exercise, right? I think a lot of times when people hear the term overfitted, they just immediately discount a model. If they hear that a model is overfitted, they just say, oh, it's garbage. Useless model. I don't care. Don't even talk to me about it anymore. This is garbage. But I want to offer a more nuanced perspective on that, because I don't fully agree. So what I will say about overfit models is that they are terrible for predicting far into the future, right? Clearly. This just doesn't do a good job of holding up going into the future. So they're bad at predicting far into the future, and way worse than a model like this, right? This model here fit to that exact same point. Reasonably good job all the way up till today. The model is just showing you here, not so much. This is underselling Bitcoin's price by quite a bit at this point. But let's say we don't care about that. Let's say we're not trying to use this model to predict the future, at least into any far distant realm of time, right? We're not trying to predict out, several years past when we fit it. We're not trying to predict 4 years out. Let's imagine that we're instead interested in some other questions. So I'm going to talk a bit more about shorter term predictions based on models like this. But there's also information that we can get just merely from looking at how these different factors have impacted Bitcoin's price over its history that can give us some useful information. So that's what I'm showing you here is the effect of these different variables over Bitcoin's entire history as predicted by that best fit model. So what I'm showing you here is the predictor. So intercept is just that constant. Don't really need to worry too much about that. Time being that kind of catch-all for everything we're not considering we're not factoring in on these other variables, SP 500, M2, money supply, and then active addresses. So we can see that over how these different factors have impacted Bitcoin's price over its entire history. And what's interesting is if we look at these regression coefficients here, so denoted by B. So what these coefficients think of them as slopes. So this is a little bit hard to envision just because it's in the logarithmic form, but essentially the way you can read it is that what these betas mean is that for every one increase on this factor, which because it's in logarithmic form, it would actually be a 10x. I use log base 10 for these models. So for every 10x in time, so every time that time increases by 10, that's actually been associated with a negative 10x essentially. A move down. With logarithmic, you're basically going from here to here. This is a 1 unit increase, 1 unit increase, 1 unit increase. So it'd be going from 1,000 to 100, for example. So there's this negative effect, right? For every 10x increase in time, there's kind of a negative 10x effect on the price of Bitcoin. For the S&P 500, for every time the S&P 500 goes up 10x, you'd expect Bitcoin to go up by 6.55 10x's, or another way of thinking about that would be 65.5 x increase in Bitcoin's price. Interestingly, for the money supply, what I was talking about before is that maybe this could have gone either way, right? Maybe inflation would have helped Bitcoin because Bitcoin has a set rate of inflation itself. So if the dollar is debasing itself faster than Bitcoin is inflating, you might have just expected that purely on its own would increase Bitcoin's price. Actually, it hasn't. It's actually been negative. That as the money supply has been increasing, that's actually been having a negative effect on Bitcoin's price. Same thing, and then interesting with active addresses, this has been having a positive effect, but for every 10x increase in active addresses, you can expect a 10.1x basically increase in Bitcoin's price. So it is a positive effect, but not anything too staggering like the S&P 500 here. And what's important to note about reading the output of this kind of model is that these are the effects of the variable controlling for all the other variables. And what that means is that essentially, 6.55 here, this is the effect of S&P 500 if you hold everything else constant, right? So if you imagine that you'd hold constant whatever variables are actually impacting time, whatever time is acting as a proxy for, hold that constant, hold all those factors constant, hold the money supply constant, hold the number of active addresses constant on the Bitcoin network, then you would expect that for every 10x increase in the S&P 500, there'd be a 65.5x increase in the Bitcoin price. That's basically what that's meaning, is that this is the effect of the S&P 500 that's separable from the effects of these other things, right? So it's not redundant. There's nothing redundant about this effect with what you're already explaining by these other factors. It's the unique impact of the S&P 500, or the factors that are underlying the S&P 500 fluctuation, however those are predicting Bitcoin, the unique effect of them on the Bitcoin price. So you're basically able to just say, what is the unique effect of the money supply if you control for these other factors? and then time being this kind of general proxy factor as well. So another one I think is really interesting is this negative effect of time, right? Because with those time-based models, this is a positive slope because it's just catching that kind of general positive increase in Bitcoin. So what does this look like? So this is the kind of the slope that it looks like. You can ignore the kind of exact level it's at. That's not all that important. It's more just looking at the slope here. And what it shows is that once you account for all the things that are underlying the SP 500, all the things that are kind of related to or are accounted for by active addresses and the money supply, then whatever's left over is actually having a negative effect on Bitcoin's price. So whatever time is acting as a proxy for, once we account for these other factors, is actually having a suppressing effect on Bitcoin's price. Now, one thing that I haven't accounted for in this model that's obviously really important is just the supply of Bitcoin. Right? As Bitcoin's gone, miners are producing new Bitcoin. There's inflation in the Bitcoin supply, and it's ever growing total number of Bitcoin, and that's what I suspect is probably a big part of what's driving this. Is just that as more Bitcoin are mined, that's obviously going to be a negative driver on Bitcoin's price. So that's probably a part of it. But there could be other things that are also underlying that would be in addition. So obviously I've not tried to account for everything in this model, but that's just one thing that could be speculated about. But really with the money supply, that's one place where I think that just in and of itself, that's a useful answer, a useful piece of information from this exercise, because different people would have argued different things, I think, right? I think some people would have argued that increase in money supply in and of itself will just be good for Bitcoin because, if the dollar is debasing itself faster than Bitcoin, if Bitcoin's inflating, then Bitcoin should just grow relative to the dollar. But in fact, that's not been the case. That inflation has actually been harming Bitcoin over time, or at the very least, inflation as proxied by money supply. Greater money supply has actually been harming Bitcoin, which is, I think, really interesting. So let's talk about another final thing that I want to talk about with this. And this is the ability of using one of these models just to kind of test out different hypotheses in more short-term price predictions. So, we talked already about how this kind of model is not good about projecting 4 years in the future. And frankly, even if it was good, you wouldn't really want to do it, or wouldn't really be all that useful to you to try to project that far in the future with a model like this. Because remember, you'd have to be making predictions about where the SP 500 would be in 4 years, where the money supply would be in 4 years, where active addresses would be in 4 years. You'd just be making a ton of assumptions that would make it more and more kind of questionable what you're doing. So this kind of model just isn't good for that. It's going to be overfit, and it's just also questionable what you'd even use as your inputs to project that far into the future. Where I think it is a little bit more interesting and potentially useful, at least to give some rough guidance, is near future predictions. So we can see that overall, this has been this follows the Bitcoin's price in kind of recent history a lot closer than just that basic logarithmic, just time model did. Certainly, it's kind of following along more closely. And what you can also see is that if I fit the data up until just the beginning of 2021 on this model, it's not looking as bad as that one that I fit back to the beginning of 2018, right? So from over the past year and a bit, it's not as good as the totally fit model. It's not horrible, and certainly within a few months after that general fitting, it was doing a reasonable job of getting some expectations about where price would be based on these different inputs on these different ones here. And so that's where I think that just looking for the more short term, if we want to ask the question of, what if certain things were to happen, we can then look at predictions about price based on a model like this. So that's what I want to talk about next. It's just, this is obviously going to be a questionable exercise. You don't want to take the numbers that result out of this too seriously. But I think it's just kind of fun to say, okay, what would happen if the S&P 500 went up by 10% in the next 30 days? What would this model think that would put the Bitcoin price at if everything else stayed constant? So the money supply and active addresses, everything else stayed roughly constant. What would just that change in the S&P 500 mean for Bitcoin's price in the next 30 days or something? That's what I think is useful or interesting of looking at here. So that's what I'm going to show you on this table here, is just taking this kind of very super fit model, not trying to predict super far in the future, just a little bit, just a month in the future, and just see what it expects would happen to Bitcoin's price if different scenarios were to play out. So what I'm showing you here is just different scenarios, and essentially I'm just holding all the other factors in the model constant. So I'm just saying if the S&P 500 price drops by 10%, assuming everything else doesn't really change much, and that were to happen in the next 30 days, what would that mean for Bitcoin's price? So that's what this one's looking at here. And here what we can see is that it thinks that Bitcoin's price would drop pretty noticeably. It would drop to, just under 23K if everything else stayed constant, of course, in those different in that model. Now, of course, that's a questionable assumption, right? Most likely, if S&P 500 price is dropping by 10%, other factors are also varying, so this would obviously be a different number. But just to give us a rough guidance, a rough ballpark, this is interesting, right? And it just gives us a way of calibrating our minds or our mental models to what different changes in these variables would mean in different time frames. So over the next month, if the S&P 500 dropped another 10%, which would be pretty bad off of given the correction we already had, that it would expect Bitcoin price would correct quite hard along with it. But then if the S&P 500 were to rally 10% in the next 30 days, it actually expects quite a bit of upside that Bitcoin could see there. Now again, you have to take this all with a huge grain of salt. This is by no means guaranteeing that if we see a S&P 500 rise by 10% in the next 30 days, that Bitcoin's going to be sitting at 85K. But certainly it thinks that there'd be a lot of realistic upside potential, right? You know, that'd be over a 2x from where, over 2x from where we are right now. Not bad. Then we can look at other variables like active addresses. If that were to rise by 10%, then that would put us up at about 50K expectations. So if you saw about a 10% rise in demand and everything else is constant, so the macro environment kind of stayed exactly where it is right now, then we'd expect that. And then what we can also do with this model, which is kind of fun, is put combinations in and see what happens. So what happens if demand, active addresses, you know, if a proxy for demand, with that rate raised by 10% and the S&P 500 drops by 10%? Well, we still expect Bitcoin's price to fall, but not as far as if the active addresses stayed constant. So in some ways that could act, if we saw these going against each other, this would be acting kind of maybe as a buffer against the downward pressure that this would be predicting. But then if we predict a combination of the two, active addresses rising by 10% and the S&P 500 rising by 10%, that would put us up close to 100K just in the next month if we were to see that unfolding from this model's perspective. Now again, you have to take all of this with a massive grain of salt because, you know, it's questionable to say that all the other factors would stay constant over the next 30 days. They probably wouldn't. And also that necessarily all of the relations that we're currently seeing between these factors and the Bitcoin's price would stay exactly the same. Probably wouldn't. But what this can do is give us just a rough ballpark of where we might expect the price to go if these different scenarios played out. That if the S&P 500 were to rise by 10% and everything else stayed roughly equal, then that would be great for Bitcoin. That would be really good. If it drops by 10% without everything else staying largely equal, terrible. We really don't want to see that. That's when we're getting to those bearish predictions some people are putting out of, you know, going back to 20K or whatever. That's when that would become maybe more realistic. But then likewise, you know, you can do these combinations or just looking at demand. I just think it's kind of an interesting exercise to get just some ballpark ideas, some kind of rough guidance of what we might expect if different scenarios were to play out. So my ultimate kind of takeaway from this, and what I really just wanted to talk about with this video, is that there's different ways of thinking about Bitcoin fair value, right? You know, the way that's oftentimes talked about is this one. And in some ways, I think this is the one that makes the most sense just because it is the safest in a way. You know, it's the one that's the least susceptible to being overfit. You know, it's not really relying on other factors that the relationship between Bitcoin and S&P 500 can change a lot over time. If you're just letting time be this overall proxy, it can kind of wash all that out. It doesn't really care. It's just capturing the overall kind of growth. Kind of just whatever is driving Bitcoin's price, that's what it's quantifying. But what I do think is interesting about these kind of models, where you do take more into account, is that it can kind of give you a different perspective on history of Bitcoin's price action. It can let you do some kind of fun prediction into the near term of just what would happen if different scenarios were to play out. And then just also give us just another different perspective on current fair value, right? Because you'll notice that for the time-based fair value, we've been overvalued this entire time. Ever since, you know, going into this parabolic run at the beginning of 2021, you know, we've been over the fair value line that entire time. We're overvalued. But here we're actually undervalued to the best fit line when we take those other factors into direct account. We've been kind of more or less undervalued or tracking this entire time, and we're currently still a little bit undervalued. Now, it's important to mention that there's a confidence interval that goes around any model like this, so it's a little bit dubious to say that we're necessarily below the fair value. If anything, we're just kind of roughly on par. So these two things might be kind of telling roughly similar things. But certainly it wouldn't be saying that we've been in as much of a bubble, you know, back through here as this model was saying, that it's been kind of more or less expected given our current fit of the model that we'd be up through here, whereas that, you know, won't show up in this kind of a model here. So it just gives a different perspective. And personally, I just think that both are useful for different reasons. And I also just wanted to talk about this to just give a different perspective on overfitting, right? Because I think oftentimes when people hear the term overfitting, they just want to throw the model out immediately without taking it any more seriously. I do think that taking into account these other factors, and even just acknowledging that, yeah, sure, this is an overfit model, and you can totally acknowledge it, there's still some useful information that you can glean out of an overfit model. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with UDPI, we're all going to make it.